So welcome to ACL Forces 8. Today we are looking at modified audit reports. In a modified audit report, the auditor can either give a modified opinion or an unmodified opinion. If the auditor is giving an unmodified opinion, then probably there is an emphasis of matter paragraph or other matter paragraph. Otherwise, the auditor gives a modified opinion in a modified audit report. So the types of opinion the auditor can give under the modified opinion are disclaimer of opinion, adverse opinion, and then qualified opinion. By the qualified opinion, we can break it down to qualified opinion except for or qualified except for might. When you go to some books, they will tell you that there are 3 types of modified opinion. Others will also tell you 4 types. It's actually the qualified that we break it down to except for and then except for might. That makes it 4. Otherwise, it is qualified, adverse, and then what? Disclaimer. So the basic elements of a modified audit report would then be the title, addressee, then the modified opinion. So the modified opinion, it depends. If the opinion is qualified, you wouldn't write modified opinion, you write qualified opinion. If it's adverse, you write adverse opinion. If it's a disclaimer, you write disclaimer of what? Disclaimer opinion. Then you come to basis of the modified opinion. So if it was adverse, it will be basis of adverse opinion. If it was qualified, it will be basis of qualified opinion. And if it's disclaimer, it will be basis of disclaimer of opinion. So the modified audit report can have a modified opinion, or it can have emphasis of matter or other matter paragraph, or it can have both. It can have the opinion modified and then it can also contain the emphasis of matter and other matter paragraph. So kindly take note of that. Then the rest will follow suit, key audits and matters. This should be key audit matters. Let me correct it. Discard. Key audit matters. Okay. Then other information included in the financial statements, management responsibility, auditor's responsibility. Auditors, their report on the other legal regulatory requirement, their signature, date, and then the auditor's address. So apart from those in the blue ink, the rest will be the same as that of the unmodified audit report. So the focus of this lecture is to discuss the 4 types of what? Modified opinion, and maybe look into emphasis of matter and other matter paragraph. That's the focus of this lecture. So the modified opinion, we have the qualified except for or adverse. Let me take you to this one first. The first 2, okay. The first 2. Qualified except for and then the adverse opinion. The auditor will issue these 2 opinions when he has received all the necessary audit evidence, but then he disagrees with it. I don't have enough space, so I can't write my disagree. Okay. And then the last 2, except for might and then disclaimer, it happens when the auditor did not receive sufficient and appropriate audit evidence. He did not receive sufficient evidence. But with the first one, the first two, he received the evidence all right, but he disagrees with it. But the second instance, the qualified and then it says for might. Let me use the laser. The qualified, it says for might, and then the disclaimer. The auditor is saying that he did not receive enough information for him to base on that to express an opinion. But with the first two, the auditor is saying that the information that he has received, he disagrees with it. So let's take the first two, except for and or the adverse. So he's saying that based on the audit evidence obtained, the financial statements as a whole are not free from material misstatement. He disagrees with the figures and then the disclosures in the financial statement. He thinks that as the figures appears, there exists some material misstatement in the financial statement. And this would include uncorrected misstatements that are material and what? The appropriateness of application of accounting policy, the failure to disclose information and all that. Whenever some of these things happen, then the auditor is likely to issue a qualified except for opinion or an adverse opinion. Very soon I'll tell you when he gives the qualified except for and when he will give the adverse. But at this point, what I want you to know is that here the auditor has received the necessary information. He has received the necessary audit evidence. But then he thinks that the financial statement is not free from material misstatement. He disagrees with the figures in there. That is when he issues the qualified except for or the adverse opinion. When will the auditor issue the qualified except for might or the disclaimer of opinion? When the auditor is unable to obtain sufficient appropriate audit evidence. So being unable to obtain sufficient and appropriate audit evidence to conclude that the financial statements as a whole are free from material misstatement. When that happens, he either goes for qualified except for might or a disclaimer of opinion. So what are some of the circumstances? Circumstances beyond the control of the entity, such as fire, that damage accounting records. When that happens, there is no way the organization can get you probably the record that you're looking for because it has been damaged. The circumstances relating to the nature or timing of the auditor's work, such as inability to attend inventory count and all that. And then limitations imposed by management, such as management not allowing the auditor to obtain external confirmation of certain receivable items and then bank confirmation requests and all that. When those impediments are put in place, they're saying that it limits the auditor from getting the necessary information, from getting the necessary audit evidence. So when that happens, he either issues a qualified except for or a disclaimer of opinion. Okay. So under what circumstance would the auditor gives the qualified opinion or the adverse opinion? You have already established the fact that this happens when there is a disagreement or he thinks the financial statements are materially misstated. So if the auditor thinks that his disagreement or the material misstatement he's suspecting the financial statement is material, okay, but it's not pervasive, then he will issue a qualified opinion. But if the auditor is thinking that his disagreement or the misstatement, the supposed misstatement in the financial statement is both material and pervasive, then he's issuing an adverse opinion. So a qualified opinion simply means the auditor is saying that except for maybe sales and revenue, the rest of the financial statement gives a true and fair view. So except for one or two items in the financial statement, which I think is materially misstated, the rest of the financial statement gives a true and fair view. Then the adverse opinion, the auditor will be saying that I think the financial statement does not give a true and fair view. That's the adverse opinion. It is a serious situation. As an organization, you don't have to reach this point. When the auditor claims that the financial statement does not give a true and fair view, then he's trying to say that majority of the figures and disclosures and elements in the financial statements are materially misstated. Either majority of them are materially misstated or the entire financial statement is what? Materially misstated. So that's what the auditor is saying. So he thinks the financial statement does not give a true and fair view. What do you mean by material but not pervasive? That's when the auditor encounters a material problem with one or more specific item in the financial statement, such as problem with inventory or revenue, but the remaining items in the financial statement as a whole provide a true and fair view. So whenever that happens, then we say it is material but not pervasive. Then what do you mean by both material and pervasive? Pervasive effects on the financial statements are defined by ISA 705 as though that contain in the auditor's judgment that are not confined to specific elements, accounts or items in a financial statement. They are confined to specific elements, accounts or items in the financial statement, but represent or could represent substantial portion of the financial statement. And then in relation to disclosures are fundamental to the users. Okay, the user's understanding of the financial statement. So whenever this happens, then we say it is material and then pervasive. It is not confined to specific elements. Even if it's confined to specific elements, those elements represent a substantial portion of the entire financial statement as a whole, or whatever the issue is in relation to a disclosure that are fundamental to the user's understanding. When this happens, then we say it is both material and then pervasive. So if the auditor's disagreement with the financial statement is material but not pervasive, he will issue a qualified except for opinion. And he's simply saying that except for one or two items in the financial statement, which is materially misstated, the rest gives a true and fair view. But in an adverse opinion, the auditor is saying that the entire financial statement is materially misstated. It doesn't give a true and fair view. So this is a serious form of what? It's the worst, opinion that can ever be given. It's the worst. You're saying it doesn't give a true and fair view. So users shouldn't rely on the financial statement. That is what you are saying. Now let us come to the second instance, where the auditor is unable to obtain sufficient and appropriate audit evidence. They're saying that if this situation is material but not pervasive, then he will issue a qualified except for might. That is inability to obtain sufficient and appropriate audit evidence. If it's both material and then pervasive, then it is material and not pervasive, then he will issue a qualified except for might. But if that issue, his inability to obtain the sufficient and appropriate audit evidence is both material and pervasive, then he will issue a disclaimer of opinion. Qualified except for might simply means that because he was unable to obtain the evidence. So he's saying that except for one or two items which I did not obtain sufficient evidence on, which might be materially misstated, the rest of the financial statement gives a true and fair view. Disclaimer of opinion simply means that the auditor is saying that I cannot give an opinion on the financial statement because I did not receive most of the information I requested for. So with disclaimer, the auditor is saying that I cannot give an opinion on the entire financial statement. And it will happen when the auditor is unable to obtain, audit evidence on most parts of the financial statement, most elements of the financial statement, or a substantial part of the financial statement. If he's unable to get information on those, then he will issue a disclaimer of opinion. He will say that the financial system, I cannot issue an opinion on it. Okay, so basically this is it. So let us see an example with a set for and then a set for might. So a set for is qualified a set for. This is when he receives the information but he disagrees with it and it concerns one or two items. So when the effect is not material and pervasive enough to require the adverse or disclaimer opinion, this applies where the sufficient appropriate audit evidence was obtained. But the auditor concludes that misstatements exist individually or in aggregate that are material but not pervasive to the financial statement. And in the assessed format, the auditor is unable to obtain sufficient appropriate audit evidence on which to base the opinion. We therefore conclude that the possible effects of the financial statements upon detecting misstatements, if any, could be material but not pervasive. So this is how it will be worded in the audit report. You say that except for the effects, the case of except for, we say except for the effects of, let's say, sales and inventory of the matter. So let me put in actual issues. Except for the effects of sales and inventory described in the basis of opinion paragraph, the rest of the financial statement gives a true and fair view. So let's look at the wording for except for might. You say that except for the possible effect of sales and inventory, which we have not received audit evidence on as described in the basis of qualified opinion paragraph, the rest of the financial statements gives a true and fair view. So this is how it will be worded. Now let us look at how the let us look at how the adverse opinion will be worded. The author will say that in our opinion, because of the significance of the matter discussed in the basis of adverse opinion paragraph, the financial statement do not present fairly in all material respect the financial position of the organization, the financial performance of the organization, statement of changes in equity of the organization. So this is how the auditor will word it. Now let us look at the disclaimer. The auditor will say that they are unable to express an opinion on the financial statement because they did not receive the necessary information. Okay. Now the basis of modification paragraph. We are done with the opinion. Under the opinion paragraph, that's where you say that in our opinion, the financial statement does not give a true and fair view. In our opinion, financial statement give a true and fair view except for maybe items 1 and 2. So after expressing that opinion, you come to the basis of modification of the opinion paragraph. So when a modification is required, the details would be provided in the basis for modification paragraph as described below. The purpose, it sets out the details of the modification in a separate paragraph, uniformly worded to the extent possible after the opinion or disclaimer of opinion on the financial statement. The paragraph would be headed as basis of qualified opinion, as I think I've already said this, basis of adverse opinion or basis of disclaimer of opinion, depending on which of these opinion you are given. Okay, the wording of the basis of opinion paragraph. So the substantive reasons for the qualification, you outline all of them. Unless impracticable, quantification of the possible effects on the financial statement of modifications involving specific amount in the financial statements, including quantitative disclosures. This would include quantification of the effects of the account balances, classes of transactions, and the disclosures affected, plus the effect on the income before taxes, net income, and then equity. When applicable, a statement that is not practical to quantify the financial state effects can also be given. So under the base for modification of opinion, you indicate clearly why you think you cannot give an opinion on the financial statement, or why you think the financial statement does not give a true and fair view. When the qualified except for or except for might, you have to indicate those issues that you think you disagree or you did not get enough information on. Give a vivid description of the issues and give the if you can quantify. Okay, if you can quantify the impact, bring all those in the basis of what? Modification of opinion paragraph. And please, you have to discuss, your decision to modify your opinion with those charged with governance. Maybe after discussing with them, they might work on it. They might decide to, resolve the issue, especially if it's qualification of the opinion, qualified acceptable. If you think you'll disagree with one or two items, for all you know, the directors will be ready to resolve the issue to ensure that management pass adjustment in order to correct the misstatement. So ISA 705 state that when the auditor expects to express a modified opinion, the auditor must communicate with those charged with governance the circumstances leading to the expected modification and the proposed wording for the modification in the auditor's report. It will allow the auditor to give notice to those charged with governance of the intended modification and the reason for it, to seek agreement or confirm disagreement with those charged with governance. And no board of directors will be willing to allow you to modify your audit opinion. So they will try and resolve the issue. It doesn't usually happen that auditing firms or auditors are modifying opinions. It doesn't usually happen. If it's adverse opinion, sit them down, let them know that these are this and this and this and this are the issues, the reasons why I am going to issue an adverse opinion. That's where you are saying that the financial statement does not give a true and fair view. Give them ample time to respond. They might be able to resolve all the issues. So it is crucial to discuss your modified opinion, or your intention to modify your audit opinion with what? Those charged with governance. Now, emphasis of matter and other matter paragraph, that's according to ISA 706. So these paragraphs provide guidance to auditors on the inclusion of paragraphs, in the auditor's report. That is that draw users' attention to a matter that is of such importance that it is fundamental to their understanding or that's relevant to their understanding of the audit and the auditor's responsibility. So with emphasis of matter or other matter paragraph, you only draw users' attention to something which is already existing in the financial statement. So usually the emphasis of matter borders on an uncertainty relating to future outcome of exceptional litigation or regulatory action, early application of a new accounting standards that has a pervasive effect on the financial statement, and a major catastrophe that has had or continues to have a significant effect on the entity's financial position. The entity would definitely disclose this information in the financial statement if they so exist. They will disclose them in the financial statement. Sometimes they will even adjust it in the financials and all that. But the auditor is just drawing users' attention to them. That's all the emphasis of matter paragraph talks about. So you insert a paragraph in the audit report and call it emphasis of matter and say that we draw attention to note X, the financial statement, which describes the uncertainty related to the outcome of the lawsuit filed against the company by XYZ company. Our opinion is not qualified in respect of this matter. Usually, when the auditors give emphasis of matter, they don't base on that to qualify or modify their opinion. That emphasis of matter paragraph is only there to draw the user's attention to certain information in the financial statement. You see, the financial statement is in the annual report, and the annual report contains a lot of other information. So we believe that the user might get distracted, might not really pay attention to certain issues and all that. And the other things that those issues that he intends to bring them under emphasis of matter, if he thinks that those issues are fundamental to the decision that the user will take, he will draw their attention. You think that is so important that it will affect the decisions of users. It's so material significant. You only draw their attention, and by drawing the user's attention to those information in the financial statement doesn't mean you are modifying your opinion. It doesn't mean so. That's why I told you that in a modified audit report, the auditor can give an unmodified opinion. But whenever that happens, then probably there is an emphasis of matter or other matter paragraph. So this is a typical example where your opinion is not modified, but you are drawing the user's attention to certain information in the financial statement. And the other matter paragraphs are virtually the same. It's a paragraph which is included in the auditor's report that refers to a matter other than those presented or disclosed in the financials. That in the auditor's judgment is relevant to users' understanding of the audit, the auditor's responsibility, or the auditor's report. Other matter paragraphs are used where the auditor considers it necessary to draw readers' attention. So we've said that the auditor is supposed to communicate with those charged with governance. That's in line with ISA 260. And then when he communicates deficiencies in internal control to those charged with governance, that would be ISA 265. So what's the objective of ISA 260? The objective of the auditor, according to the standard, is to communicate clearly with those charged with governance the responsibilities of the auditor in relation to the financial statement audit and an overview of the plan, scope, and timing of the audit to obtain from those charged with governance information relevant to the audit. Usually, before the audit starts, in the first meeting of the auditor, the first time they visit the client, they usually have a meeting with those charged with governance, board of directors. And at every point in time, they can communicate with them. As I said, as an auditor, you really deal with those people on top of the board of directors and all that, management and all that, and they respect you so much, irrespective of what your rank in the auditing firm, what you do there. So I think we discussed this in last semester, but I'll give you the slide. You can go ahead and look at some of the issues that the auditors discuss with those charged with governance. You can look at those issues. All right, so this said, I think I would like to end the lecture here. So to summarize what we've done today, in the modified audit report, the auditor can give an unmodified opinion. He can give a modified opinion. Under what circumstance would the auditor give an unmodified opinion? When there is an emphasis of matter or other matter paragraph. And then with the modified opinion, we have 4 of them. We have the disclaimer of opinion when he decides not to express any opinion, adverse opinion when he thinks the financial statement doesn't give a true and fair view. Then qualified except for opinion where he thinks that except for 1 or 2 items, the rest of the financial statement gives a true and fair view. And then qualified except for might where he thinks that except for 1 or 2 items which he did not receive the appropriate and then sufficient audit evidence, which might be materially misstated, the rest of the financial statement gives a true and fair view. Basically, this is modified audit reports, and kindly master these 4 modified opinion. Know when the auditor gives these 4 modified audit opinion, you are likely to meet it in exams. You can be asked to, explain the 4 types of modified opinion or anything about it. You definitely meet it in the exam. That's when I'm very sure of it. So thank you so much for your time. I'll see you again.